What's up, everyone? Let's get into this video and talk about another dividend stock I might buy today. So, before I go into that, why am I building this portfolio? It's very important you understand why you buy for a certain portfolio. Well, I'm buying this portfolio to put into my dividend portfolio for my bridge account. Now, why am I buying dividend stocks? According to this video right here is the reason why.
Never buy a stock that doesn't pay a dividend. That has been your advice through and through. Why are these stocks more attractive?
You look at companies that don't pay distributions, don't return capital, how risky they are. Take a GoPro, for example. I'm not just picking one company. I'm just giving you a good example of a company that basically has lost 70% of its value, never returned a dime to shareholders. Or how about a company that's been around much longer, Yahoo? Never paid a dividend. It's never made money for anybody except all the CEOs that have gone through there and got whacked.
Now, the reason why I changed up my investment strategy is because of Warren Buffett. Warren Buffett had this to say about stocks and portfolio and when to buy stocks. And this is the reason why I changed up my style of investment and I want ownership of a company.
The man with a net worth of over $100 billion has a story to share. Here's what he did.
When I was 11, I picked stocks. I had the whole wrong idea. I was interested in watching stocks, and I thought stocks were things that went up and down, and I charted them. I read books on technical analysis. I read Edwards and McGee. I think that was the classic then. Hundreds and hundreds of pages. And I read that whole thing over and over again. I read Garfield, Drew, I read everything. And I thought the first 8 years, I thought the important thing was to predict what a stock would do and predict the stock market. And then I read Ben Graham, when I was 19 or 20. And I realized that I was doing it exactly the wrong way. But it didn't hurt that I had that background and everything. I rejiggered my mind and when I read the book, The Intelligent Investor. And from that point, I never bought another stock. I bought businesses that happened to be publicly traded.
Now that you know why I'm investing like this is the reason why I'm buying dividends. I want to build passive income. Now, passive income, there is really only comes down to one of these two things. And in this video, it tells you why I invest like this.
The quickest way to not be on a beach in Mexico is to think that passive income exists. I think the reason so many scumbuckets are making so much money is because you're buying stupid courses over and over, thinking there's some magic formula for passive income. Passive income looks like this. You take money that you can afford to go to zero, and you put them into two places that have historically created passive income. Public markets, that you don't care if it goes up and down and you just wait to the end, or real estate, and you hope that your real estate area doesn't get crushed. Everything else almost doesn't exist.
That you know why I invest like this. Now let's tell you my requirement for my portfolio. 1, it has to be a dividend paying stock. No point adding to my dividend portfolio if it doesn't pay dividend. 2, it has to be financially sound and make a good profit that I know is going to be around for a long time. And number 3, it has to have growth opportunity, and I have to see it based off the numbers, not off of what the chart is saying it's doing. Now, before I tell you the stock, this is a video of the stock I'm trying to get into.
Word. And yet its power is unlimited. We unite individuals so they can accomplish extraordinary things. We build what one person alone could not. We makes even the best ideas better. We is the core of our purpose. We are Colgate, a caring, innovative growth company that's reimagining a healthier future for all people, their pets, and our planet. By harnessing the power of we, our purpose comes to life. We are making choices, big strategic choices, in areas where Colgate can excel like no other company in the world. We're building capabilities that transform how we approach our day-to-day work.
Is Colgate Palmolive. Now, in that video, you know that they deal with dentists, toothpaste, and other things like that. So I buy this product, and since I buy it, I was like, hey, why don't I take ownership? I'm already buying a product, and they make a decent product. If you don't know about them, who they are, they're a dentist company, or not dentist, they're a place that make dentist stuff, and they've been around since 1806. So they've been around for a long time. This is who they are. It's a website, but you saw in the video what they did. I did my own due diligence. Make sure you always do your own. Now, like and subscribe to my video, and let's get into this stock. What do I think about it? And let's look at what it has been doing. Well, year to date, it dropped 7.49%. 1 year, it dropped negative 22.03. 3 years is 7.73%. And 5 years is 8.83%. Man, it doesn't look that great. What's going on with it? But let's see what the finance is doing. But before we get into the finance, let's go into the dividend. So what is the dividend for them? The dividend is 2.48. They have an annual dividend yield of $2.08. And they've been growing their dividend for 62 years. That's a very good long term. And the dividend growth is 4.08%. So this is a good stock to buy if you're looking for a dividend paying stock. They've been growing it for 62 years, and that really intrigues me. I really like the idea, but let's go into the finance of it and see why it might be dropping. So the finance from 2017, it looks like it's been increasing little by little. And in 2023, it jumped from $19 billion to $20 billion. So it had an increase year over year. This is what I like to see, that it is growing year over year. So yes, it's a good stock to buy if it's growing. Why is the chart going down? I don't know. You know, what the chart does is not what I'm worried about. It's what the finance is doing for me. And I like to go down and look at the gross margin. The gross margin is 60.50%. That's a really good gross margin. And then the net profit is 15.17%. Year before is 12.62%. And the year before that's 10.95%. So guess what? It has a good net profit and a good gross margin. But before we say it's doing really well, let's look at the balance sheet. How has it been doing? So $15 billion for current asset and fixed asset, and the current liability is 5, and long-term debt is 7. So it's $11 billion. Let's say $12 billion. Man, that's really close. They're right on the edge. They're in the profit, but at the end of the day, they're still doing pretty well. Now let's look at the cash flow. How have they been doing in the cash flow? So in 2022 to 2024, the cash flow increased. I like to see that. So they're putting more cash in. Operation cash flow went up, and they still have more free cash flow in their account. So financially, I think they're doing pretty good. So the earnings, how have they been doing each quarter? Well, each quarter they've been hitting their earnings and they've been beating it. So, okay. And now the analyst says it's a buy. Now, I'll let you know what I think about it in a little bit, but let's see what the Vanguard Group think. If they purchased it, BlackRock sold some, State Street sold some. Okay, so 2 big companies sold it. Could have caused a dip, but who knows? Let's go into what AI says. So AI has net profit grew below peer average. And yes, I agree, it shows it. But what does overall for the valuation of this company? The valuation is right at peer average and it's a 5 out of 6. I agree with it. It's keeping up with these bigger corporations, Procter & Gamble, Kimberly-Clark, Clorox, and Campbell Company. And then the earnings, it's doing outrageous. 5 out of 6. I think it's actually doing better than 5 out of 6. But they probably gave it 5 out of 6 stars because it's not at the peer average. It's below peer average. Future growth of the company is 4 out of 6. I agree with it. I think the future growth is 4 out of 6. Historical performance is 2 out of 6. Yeah, according to the chart, it hasn't been doing too good. And financial health is 5 out of 6. If you look at it, yep, it's doing pretty good on the current ratio versus peer and industry. So yes. And then what do I think about this stock? You know what? If I go off the max and look at the bigger picture, it looks like it's hitting a dip, but at the end of the day, I think this is a perfect time for me to buy this company because it looks like, according to the finance, that it's doing really good. It shouldn't be dipping according to the charts or the finances, but it is dropping. I don't know why, but it's a solid company, and this is exactly what I'm looking for. It pays a dividend. It has a dividend yield of 2.44% and over 65 years of dividend growth. So that's one plus for me. The only issue, it comes down to the 1 year and year-to-date growth of the company, and it's not doing so good there. But I'm looking at the long term. And the long term, if you take away what happened and that big dip, it's going to recover. And if it does recover, it's the perfect time to get a good growth. Now, remember, I'm looking for 5 years, 10 years down the road, and I'm not looking for tomorrow. This is a good blue chip company to add to my portfolio. Am I going to add a whole lot of it? No. I might add $500, $1,000 to my portfolio and just keep it there and watch what it does for the next 5 years. Because I think this is a good stock to have, a good dividend paying stock that has a long track record of paying. So personally, I'm adding this to my portfolio. Yes, the growth opportunity might not look like it on the chart, but when I look at the finances, it looks like a good, stable company for me to buy because it has no reason why it should have dropped. Whenever you look at the finances, it has no reason why it should drop according to AI. So AI gave this stock a 4.5. And that's, for me, that's a pretty good sign that this company has an opportunity to grow. It is a buy, and analyst does say it expect it to be $95. Now, do you go off of what the analyst says every time? No, but in this indication, whenever I look at the projective, it's a pretty good chance that it's going to be hitting $88, and I might get a good opportunity to take a part of this, and it looks like it's just a dip, in my opinion. Now, always do your due diligence, like and subscribe to my video, and I'll be adding this to my portfolio. Like and subscribe, and bye,